In this video, we will share 3 ways to use the moving average indicator to generate accurate trade signals. If you are serious about trading, you should definitely check out our free training program. The links are in the description below. With that being said, let's get into today's video. What is a moving average? A moving average is a simple technical indicator that calculates the average closing price of an asset over a particular period of time. So, a 10-period moving average calculates the average close price of the last 10 candles. A moving average helps us reduce the noise of the markets and paint a clear picture of a trend. Different moving averages are used for different trends. A 200-period moving average can be used to identify the long-term trend of the market. Similarly, a 20-period moving average can be used to determine the short-term trend of the markets. 20, 50, 100, and 200 are some of the most popular moving averages. Generally speaking, a moving average is used to identify the trend of markets and simplify the price action. But let's dive deep into the specific uses of the moving average that can help us make better trade decisions. Uses of a moving average. The moving average primarily has 3 uses. Number 1. Identify the trend. Number 2. Identify a trend change. Number 3. Identify areas of support and resistance. Let's start with identifying the trend using the moving average. The moving average is a trend indicator. Therefore, its primary function is to help us identify the trend of the price. Now, we have 3 techniques to accomplish that. Price versus moving average. The location of the price compared to the moving average can help us determine the trend of the markets. If the price is currently above the moving average and has consistently stayed above it, then the price is considered to be in an uptrend. As a logical trader, we want to trade in the direction of the trend. Therefore, we should be looking out for buy opportunities in this scenario. On the other hand, if the price is below the moving average and has stayed below it for some time, then the price can be considered to be in a downtrend. We should look for selling opportunities in this case. Lastly, in sideways or range-bound markets, you will see that the price does not stay above or below the moving average for longer periods. It always switches above and below the MA like a pendulum. In such scenarios, it is best to stay away and wait for a clear trend to develop. A simple trick for a better analysis would be to use the 2 moving averages with different period settings. This way, you get the long-term and short-term analysis of the price. Here is a simple example. On this chart, we have 2 moving averages. The yellow line is a 20 MA, and the blue line is a 200 MA. The 20 MA is a short-term moving average, so it should give us the short-term trend of the markets. Similarly, the 200 MA is a long-term moving average. Therefore, it gives us the long-term trend of the markets. Now, let's completely ignore the 200 MA for a moment. If we only focus on the 20 MA, we can say that during these periods, the price was above the moving average, which indicates that the price is in an uptrend. So we should look for buying opportunities. Similarly, during these periods, the price was below the moving average, which indicates that the price was in a downtrend. Therefore, we should look for selling opportunities. But if we look closely, there was not a lot of price movements in these down moves. Now, if we add the 200 MA back, we can see that the price stayed above the 200 MA for the whole time. This indicates that the price was in a long-term uptrend for the whole time. With this extra information, we can say that selling during this period would have been risky because we would have been trading against the long-term trend. Here is another example. When we zoom into this section of the chart, we see that the price was moving around the 20 MA for an extended period of time. Therefore, it means that the price is in a short-term sideways trend. But at the same time, the price stayed above the 200 MA. This means that the price is in a long-term uptrend. So, we have a sideways trend with a long-term upward bias. In such a case, either we avoid trading because of the sideways movement, or we can place buy trades around the lower end of the range. But we cannot enter sell trades at the upper end of the range because that would go against the long-term trend. Using two moving averages will not provide you with better trades, but it will help you avoid bad trades. If you are enjoying the video so far, then like this video and subscribe to our channel so that you never miss our new videos. Moving average slope. The slope of the moving average also gives us a good hint about the strength of the trend. In an uptrend, the moving average is sloped upwards. In a strong uptrend, the slope of the moving average will be steep and close to a 45-degree angle. While in a weak uptrend, we see a gentle upward slope. The same thing applies to downtrends. In a strong downtrend, we see a steep downward slope with approximately a 45-degree angle. In a weak downtrend, we have a gentle downward slope. This information is helpful because if the trends are strong, we can be more aggressive in our entries. But if the trend is weak, we must be more careful with our trades. Large versus small moving average. Another way to identify the trend of the market is by using two moving averages and looking at their positions. For example, we have plotted a 50 and 200 MA on the chart. The 50 MA is called the smaller MA, and the 200 is the larger MA. When the smaller MA is above the larger MA, the price is considered to be in an uptrend. And in an uptrend, we look for buying opportunities. On the other hand, when the smaller MA is below the larger MA, we consider the price to be in a downtrend. And as logical traders, we need to look for selling opportunities in these times. So these were the three techniques that can be used to identify the trend using the moving average indicator. Now let's learn how to use the moving average to identify reversals. To identify a trend reversal, we have two techniques. Number 1, price crossover. As we discussed earlier, the price tends to remain above the moving average in an uptrend, and in a downtrend, the price remains below the moving average. Using the same logic, when the price crosses the moving average from above, it indicates that the uptrend is over and a downtrend will begin. Therefore, it indicates a bearish reversal in price. Similarly, when the price crosses above the moving average from below, it indicates that the downtrend is over and the price will start a new uptrend. Remember, not all crossovers are signals, and many of them can be fake signals. To avoid such false signals, we can use a moving average crossover instead. A moving average crossover is one of the most popular ways to use the indicator. For this, we need two moving averages with two different period settings. Just like earlier, we will use the 50 and 200 MA for this as well. Earlier, we learned that in an uptrend, the smaller MA is above the larger MA. Similarly, in a downtrend, the smaller MA is below the larger MA. Using the same logic, we can say that whenever the smaller MA crosses below the larger MA, it indicates that the price has shifted from an uptrend to a downtrend. So, it is a sign of a bearish reversal. Similarly, when the smaller MA crosses above the larger MA, it indicates that the price has shifted from a downtrend to an uptrend. Hence, it is a sign of a bullish reversal. We do not suggest you place trades at these reversals, but you can use them with other factors to make better trade decisions. So, these were the two techniques to identify reversal. We are now moving on to one of the most important uses of the moving average: identifying dynamic levels of support and resistance. When we talk about support and resistance, we talk about a fixed price level where the price is expected to reverse. However, the moving averages can act as a dynamic level of support and resistance. In an uptrend, we see that the price stays above the moving average. Now, whenever the price returns to the moving average, the price finds support. So we can look for buying opportunities near the moving average in an uptrend. In this example, the moving average provides support to the price on 3 different occasions. On the other hand, in a downtrend, we see that the price stays below the moving average, and whenever the price comes near the moving average, it finds resistance. So, we can look for selling opportunities near the moving average in a downtrend. In fact, the price finds resistance for a total of 5 times. So this is how the moving average can act as a level of support and resistance for the price. And that brings us to the end of this video. In this video, we learned how to use the moving average indicator for our trading. If you are seriously interested in learning, then you can check out our free training. The links are in the description below. If you like this video, then be sure to hit the like button and subscribe to our channel so that you don't miss any of our new videos. See you soon!